as well. So please make sure that that you reach out to them and keep them on your file. With that, I'm going to turn it over to Mr. Mark Alley to get things going.
Excellent. We were hoping to have Dave Carrillo in between us, but we have some technical issues going on, so I'll kind of jump in. As such, though, I want to give a shout out to the Workplace Retirement Solutions crew and Dave Carrillo's crew. They have been an amazing help and resource for MassMutual advisors with the rollout of the RMS EasyPlan, and we couldn't do it without them. With that said, I'd like to welcome all those in attendance today. We're excited about the panel discussion. I know some of the panelists personally. It's a pretty smart group, and I've been amazed at the success that they've had with the RMS EasyPlan. My name is Mark Alley. I'm Senior Vice President and Head of Strategic Partnerships at Alerus, and we have no bigger strategic partner than MassMutual. It's been a great relationship. For those not familiar with Alerus, Alerus is a diversified financial services firm. Our parent company is a regional banking interest out of the Dakotas, Minneapolis, St. Paul, Phoenix, Scottsdale area. Our retirement and benefits division, which is made up of both health and welfare, as well as retirement, makes up a large portion of the company's profit. We are a publicly traded company. We went public on the NASDAQ in 2019. That being said, Alerus is an ESOP company, and our largest shareholder is the employees. And we think that makes a difference, one, on how we approach the business, and two, we have staying power. And we're not a venture capital company. We're not private equity. We won't be sold. We are a net acquirer of businesses moving forward. When you take a look at Alerus, just focusing in on the retirement plan side of it, we are a full service provider, providing everything from 401k, 403b, ESOP, cash balance plans, you name it, non-qualified deferred comp. So we really offer all types of plans. Our focus today is on the RMS EasyPlan. We have had the luxury to work with other broker dealers, aggregators across the country, but the success of the RMS EasyPlan has really been unparalleled, and it's a great story. So great to have the panelists here talking to us today, giving us our experience of what they're seeing in the marketplace. Through our intuitive technology, expert staff, and consultative approach, Alerus has become one of the largest independent record keepers in the nation, specifically targeting with advisors and plan sponsors. Before we get into introduction of the panelists, Dave, it seems like we're getting a growing number of people out there. Maybe we could take a look at what the overall level of experience is.
Yeah. I'm going to put a poll out there, folks. Bear with me. This is my first time doing this, so let's see if this works. How many plans do you all service?
Everybody could enter that in. We'll kind of let the results roll in, and I would like to turn it over to the panelists, our esteemed panelists, to introduce themselves as we go, maybe starting off with Mr. Steve Johnian.
Sure. Thanks, Mark, and thanks, Dave. So I'm Steve Johnian. I help run the corporate client side of SFP Wealth. We're certainly one of the largest production teams and retirement production teams at MassMutual. We oversee almost $2 billion now in corporate retirement plan assets, and we've got hundreds of retirement plan clients and thousands upon thousands of participants in our book of business. We're a team of around 30 people based just outside of Boston, Massachusetts. I've been in the retirement plan space for about 16 years prior to joining MassMutual. And, I probably know a lot of you in the audience. I connect with advisors all around the country to just share ideas and, offer input where I can. So, thanks for having me.
Right on. Bradley, how about you?
Thanks again for having me, and I appreciate everybody being on the call today. My name is Bradley Troy. I'm an advisor with First Financial Group, which is a Bethesda, Maryland-based wealth management firm. I joined First Financial Group back in 1992 when I was much younger. We had a third-party administration company within the organization, and I built a wealth management practice and a qualified retirement plan consulting practice that really kind of took off post Dodd-Frank. We now manage about 100 individual plans, one large MEP that's got about 150 companies in it, and total assets are something like $350, $400 million. So very different than what Stephen's doing, but organic wealth management and fiduciary consulting practice.
Thank you. Max, last
Awesome.
but not least.
All right. Well, I'm 15 years in the business. I'm a partner in a team called Kaizen Planning Wealth Management. There's 3 partners, 2 advisors, and 3 full-time staff people. Our start into 401ks was really trying to work with businesses and business owners on funding, buy, sells, non-qual deferred comp, key person planning, individual financial planning, and we found that it was difficult to get in with those people. And so when we did win those folks, we'd end up by default oftentimes winning their 401k, and we realized that going in after the 401k was a bit of our Trojan horse to get in to build the relationships with the businesses and business owners, and kind of became our way to win all of the other business that we were after. And so we manage around 100 401k plans, even less assets than Stephen or Bradley, but it has led us to some of our largest personal planning cases, some of our largest lateral cases, and obviously just really helped slingshot us forward. It's made it easy for us to recruit to our team because we have so many participants within those 401ks that we're able to really, cross-sell and work with on an individual participant level, which has helped fuel what we do from a personal planning perspective. So that's a little bit about us.
Right on. Thank you very much. Well, we have a list of hermetically sealed questions that I'm going to dive into, but I will remind everybody that this is your time. So if you have questions, put them into the chat. Dave is monitoring that, and we'd love to throw them into the mix. Starting off, Steve, you've been in the business a long time, and you kind of have the unique perspective of having worked at the home office, running a desk, as well as now coming out to the dark side as an advisor and on a production side. If you take a look at the industry, how has Secure Act 2.0 and things like state mandated plans really affected your practice and how you approach the marketplace?
Yeah, no, it's a good question. I could probably talk for far too long on this, but yeah, I mean, there's probably, I would say, 2 things going on there that have caused us to think differently. Number one, when we look at like what things like state mandates and the Secure Act are doing, they're creating a lot of tailwinds in the marketplace, making the SMB market, the small business owner market, bigger and bigger when it comes to retirement plans, right? So, if we looked at, the small business owner market of, employers with less than 100 employees, that market size is going to more than double, over the next 5 years or so. And so, we have to think differently about like, where is our new business going to come from, the profile of clients we need to be prepared to serve, because, the good CPA that might have been good for, 3 cases a year might now be good for 20 because they're getting the demand, from small businesses too, or, people that have relationships in banking channels and credit unions. So we've had to think differently about like how we prepare for the volume of business that comes next, because they're not manufacturing new $25 million and up plans every day, right? Like the plans that are getting manufactured are down market. So, that's one thing we've had to pay close attention to is, these regulations in these, whether it's on the state side or the federal side, just making the market size much bigger at a time, by the way, where there's like less and less advisors every year to support that. And so our competitors are starting to change, right? You've got large consulting firms and aggregators that are coming down market. I never used to run into Cap Trust on a $3 or $5 million plan, and now I do, right? That's sort of one thing. And then, our competitors are also changing from the perspective of now you have like direct to consumer competitors. So it's no longer just Fidelity trying to sell direct to your clients. It's the human interests of the world. It's Guideline. It's payroll companies that have figured out a way to partner with, the Guidelines of the world. They're selling direct to these clients now as well. And then I'll table some things around the convergence of wealth and retirement because our competitors are changing there as well. So yeah, we've had to think differently of like who our clients are, what are their demands, and then like just the sheer size of business now that we're going after and where it comes from.
Yeah. Yeah, really, I think those are really important thoughts. The market has always changed, right? You know, it's changed over time. And Bradley, to that end, you know, you've been in the business quite some time. More recently, have come to MassMutual. How have you seen the marketplace change, particularly? You know, back in 1992, it probably was more about picking investments because there wasn't much information out there. How have you seen that change 338 versus, you know, maybe the focus on participant outcomes, financial wellness, and the such?
Yeah, it's been quite a road, in all honesty. You know, when I started out, it was moving to 404C, where we're going to have 5 investment options, and then one day somebody created like these target date things, so that kind of changed things. But when I was starting out, I was a field rep. I started out with Equitable, and then I moved over to First Financial Group, which was awesome. And we were a guardian shop, so I was always a producer, trying to make Leaders Club with life production and disability production, the lateral stuff that these guys talk about. And I found early on that the retirement plan space was an area where, like Max's practice does, we were able to interact with executives and owners on buy sells, on deferred comp, on transitioning into personal planning type work. And so I was building out both sides of the business all the way until like probably 2009. And then the Dodd-Frank thing started to kind of identify that you're going to be a fiduciary or you're not going to be a fiduciary. And so this marketplace really started to modify. In fact, I spent a little stint with an RIA where basically they said, you're either going to do wealth management or you're going to do retirement plans. And I said, you know, maybe you guys don't understand what the conflict rules are, but I can do both. I can do wealth management and I can also be a fiduciary advisor on retirement plans. I can identify where the conflicts are. So it really has modified. The whole time, though, I really wanted to serve the participants in the retirement plan. And that's really the sticky aspect of I've had clients since 1993. These clients know that I give a darn about the participants in the plan. We're trying to make outcomes for those people. And that can be financial planning, it can be WellSense, it can be a whole bunch of other value proposition that we do in addition to the 401k plan. And so what I saw was when the Dodd-Frank stuff happened, it all of a sudden turned into we're 321. We are 321. We're doing committee meetings. We've got minutes, all this kind of stuff. And then slowly over time, what I started to see was some of the committees were like, just tell us what we're doing. Bradley, just tell me what we're doing. Whatever you say. We can look at all the scoring and all that garbage. Just tell us what we're doing. And I think what's going on now with PEPs and MEPs and 338 is really kind of a blessing for experts in this area, because a lot of the businesses, they want the employee interaction, they want the outcomes of wellness and people achieving their retirement objectives, but I don't know that they really want to spend as much time in the committee meetings doing the cerebral evaluation of the RPEG scores kind of stuff. So I think it's kind of shifted. It went from organic and interacting to this boardroom stuff to now I think our deliverable with the Alerus PEP and 338. You know, when I sat in the meeting 2 years ago and it was starting to get rolled out, I went, this is good, because a lot of my clients were asking me for more of the interaction and less of the boardroom. And so I think that it's beneficial for us because our real outcomes are with the participants, but it's also great for our field force because they don't have to feel like you can't do a 401k plan if you're not a 321, you know?
Yeah.
And do you mind if I even add on to that? That I think
Please.
like Bradley, like I think Bradley, one of the things you said, so like as I float around the country and I've talked to other MassMutual advisors, I've talked to some competitors, and one of the sort of key objections that I've heard from other MassMutual advisors is like, hey, I need to relearn what I do now, because they look at RMS EasyPlan and they go, man, this is like a full fiduciary outsourcing, program. What do I do now?
What am I getting paid for?
Usually my response is like, if your only value is picking investments, then I can replace you for 3 to 5 basis points.
Exactly.
So you've got to find a new way to reinvent yourself and add value. And, I think most employers, especially, at least the ones that we've got, experience working with, I mean, nobody loves their benefit plan. Everybody hates how much they cost, and they want somebody to talk to their people. So I just think like relearning and reinventing how we approach these clients is super important.
Yeah, really good points. We've had a lot of fee compression in the retirement plan business. Bradley, you talked about buy-sell agreements and that type of stuff. Fee compression on that, or is that stuff still pretty popular in working with business owners?
That stuff's good. We want to do both. And the thing that I think for a lot of the advisors, again, I'm getting close to 60. I learned in my 30s that the young people in the meetings would say to me afterwards, I'm doing the 401k, but my wife and I just had a kid. And I think we need to talk to somebody. Could you help me? Now I've got the people I've known for 20 years that are in the plan saying, hey, dude, I'm going to retire. I'm 63. I don't know anybody other than you. And then I pull up their stuff and I'm like, dude's got $2 million that he wants me to take over when he retires. So it's when I was in my 20s and 30s, it was, I don't know anybody. Where are the prospects? Well, guess what? I could be on the retirement plan being compensated and also meet prospects for all the other stuff we do. So I've really committed to that. And everything I just said kind of seemed a little like usury. It's for their benefit. It's for their, I always want to put their interests first. What I realize is most Americans don't ever meet an advisor. They don't have enough money to go. It's, if you've got $500,000 in an investment account, we're happy to have an appointment with you. Well, for 30 years, these people might not have $500,000, but they're interacting with us, and we're building relationships with them and credibility, and we're giving them all the good without asking them for anything because we're there to advocate for their interest in the 401k plan.
That is great stuff. And by the way, that's the thing that employers like, right? You're taking care of their employees.
That's right.
A number of years ago, we had a chairman of the board and a CEO that had a vacation home in Arizona. And so oddly enough, we have a banking presence in Arizona as well, Scottsdale and Phoenix. Most recently, we had an acquisition in Phoenix. Max, it's a different type of, I would say, client, employer base down there, in that there's a lot of service-related companies, a lot of professional service firms, not as much of the old industrial with lots of employees. How have you been using RMS to kind of service those clients, and what value are they seeing of some of the stuff you're doing down there?
Yeah, great question. For it's funny you let in with all the fun on Arizona. So I think it's a high of 80 today, so I'll rub that in your noses. But on the other side of the coin, we are the 48th state, right? So we are a newer state. There's not as much development. There's not as much old money. There aren't these 175-year-old companies that have been around with all these massive plans, right? So we're, Arizona's trying to coin themselves as like Silicon Valley 2.0, right? It's tax friendly. So there's a lot of businesses that are coming here, moving here, and some smaller, some larger, but a lot of them are having, new startup plans. And so having the ability in the past, if you did a commission-based plan, you're getting paid off funds. If you did a fee-based plan, you're still getting paid off funds. But, for me to go and set up a new 401k, whether it's 5 people or 500 people, it's still a new plan that has no compensation, and they're a lot of work, right? And they're also a lot of fiduciary responsibility and liability. And so it just was never a very, quote unquote, sexy thing to go after. And so it's nice now having the structure of RMS EasyPlan that you can charge an annual flat fee with basis points, so that I can get compensated for my time on a new startup plan, where in the past, I mean, the amount of people that say, we can't take that plan, we don't want that plan, right? I mean, we have overhead, we have expenses, and we also bear the risk of the liability, and it's simply not worth it to go make, $300 on a plan, right? It's a loss. So now to be able to actually charge and have the continued ongoing fee is something that has really been monumental for us to be able to say yes to more plans. And at the end of the day is most of those plans were going advisorless, and they get sold from ADP or Paychecks with no advisor. And it's fine because ADP and Paychecks don't serve as the advisor. So they carry and bear no liability, no risk once that plan's sold. However, the owner, CEO, CFO, HR director, whoever's signing is a trustee and fiduciary of that plan. And when they have absolutely no guidance, they've never done this before, it puts them really in a pot of boiling water, that it's not really a matter of like when things go wrong, or I'm sorry, if things go wrong, but probably more so when. And so having, the ability for us to make money, us to serve, on that plan with them, provide employee education, allow them not to have to worry about, the 316 services, signing off on loans, signing off on the Form 5500, doing the distributions, sending out notices. I mean, all that stuff's taken care of for them. So it's really been equally as wonderful for these, 100-person groups that can avoid, getting an audit, right? As much as it is for these small groups that just don't have a full-time CHRO that knows how to run 401k plan. So it's been really helpful for us, and it's allowed us to really, get compensated for the work that we want to do without having to tell people, no, I'm sorry, and we can't help you.
Nice, nice. I'd pitch this out to the larger group to kind of tack on that. Are you guys seeing being able to, when RMS Easy was designed, by the way, it wasn't designed by Alerus. I think we owe a shout out to Access Retirement Partners, as well as Dave Carrillo's group, Steve Johnian. But it was really designed as a very efficient fee structure, particularly for small plans, also for large, but for small plans to make use of the tax credits. Anybody want to jump on and talk about success that you've been having using the tax credits to cover the cost for newer plans, that type of thing?
Yeah, I mean, I'll start. I mean, I would say that for us, it's allowed us to be more consultative around how we structure fees for employers. So like if I'm a really large employer, like participants are going to share in the costs of that plan, for the most part, right? Because the you can spread costs out around a lot of people, and we're dealing with lots of varying balances. But if I'm a small business owner and I'm an owner, with the largest balance, or, a couple of owners with the largest balances in that plan, like I'm really going to end up subsidizing the cost of that plan anyway if I go pay, 1.5% to 2% to John Hancock, or I'm in an R3 share at American Funds. So not only does that not really help them leverage tax credits, but it's also not a tax efficient way for that business owner to pay fees anyway. So it's also allowed us to change the conversation a little bit to be like, hey, listen, like these plan costs are somewhere. Like, and we do head-to-head comparisons all the time to just show them that on paper. But, by the time, you owner have the largest balance, you're paying for this plan. Do you want to write it off, or do you want to pay it through your account?
Yep.
So that's helped us a lot. Before we even get to, Max, you kind of started going down this path of like profitability and not making 50 basis points on a startup, which is, zero. So that's helped us quite a bit.
Yeah, and even for the small plans, it's like oftentimes Paychecks calls them and says, oh, it's $125 a month. And then it's like, okay, well, Alerus is $4,000 annually, right? Let's just say it's $400 a month. Well, if the tax credits are covering all of it for the first 3 years, it doesn't matter. So why not get all of the wonderful 316 and 338 services that are getting covered complimentary, right? And by the time the plan grows over the next 3 years to where we want it to be, you're going to want more sophisticated service. And then, maybe this is opening another can of worms, but Alerus, can also act as the third-party administrator for cash balance plans. So if we are growing it to do profit sharing and do cash balances, we don't have to bring in other parties. It all can be done under the same roof. We have 3 cash balance plans. I know with Alerus, we rolled this out months ago, not even, over a year ago. And, we gave it a shot, and, we get illustrations back quickly. There's a lot of, coverage. If we want to have the actuary on the line, to walk through the numbers, if we want to, pull some strings on different employees, they always make time. So it's been a great place that we can start with the startups, offset the cost with the tax credits, make price and cost not even a part of the conversation, but make it about service and, really, customer care, and then also be able to grow into the plans. So it's been great for us.
Good stuff. Yeah, we do let the actuaries out of the dungeon from time to time, but not very frequently. Steve, you bring a unique perspective in working with SFP. You guys are kind of a big deal, right? You're one of the largest, if not the largest, defined contribution providers in the MassMutual network. You already have scale. You already have the resources to service plans, and you also have plans with a lot of the other providers. How does the RMS EasyPlan kind of fit into that existing big block of business that you have? And is it helping to work to expand and drive growth?
Yeah, I'd say there's a couple things here I want anyone tuning in to kind of walk away from with this question. From a scale and capacity and revenue model perspective, like we run hundreds of retirement plans. We've got them spread out across, any number of legacy platforms we've done business with over the years for one reason or another. We're structured in such a way where we have relationship managers on the team with support people underneath them as well to help run the day-to-day operation of those plans. And for all intents and purposes, they're licensed like advisors, non-producing. So they're treated like they manage their own book of business. Our capacity model for those folks is generally around, depending on size and complexity, 45 to 60 plans per relationship manager. In the PEP, and we've been testing this, and there's some more efficiencies to come, even around like annual review process in RMS. We think our relationship managers can handle 150 RMS cases by comparison. So if I can 2x or so the number, or more, the number of cases that they can own, that drives our capacity model and profitability to a much nicer place. Not to mention the ease of doing business that we've created around implementation. Setting up a plan in America Funds with a TPA takes way too long. It's hundreds of pages of paperwork with different parties that need different and or redundant information at, all at different times. You're praying you don't get a NIGO. You have a nosy TPA trying to lead a relationship with sometimes. And, by the time we're done chasing the client, I mean, we're 2 months into doing paperwork sometimes and chasing signatures and dealing with NIGOs. So like, with RMS, it's like, I have one meeting closes where I pull up the form on the call and we're done in 10 minutes. Client doesn't even sign it. We sign it, we submit it to Melissa, they get everything wrapped up and submit it over to Alerus. Within 3 business days from Alerus, we have a welcome call initiated for us and the client. So like our implementation time and ease of doing business has gone way down. I can do the pricing in my iPhone calculator. Max, I think you have an awesome story about closing a plan in an Uber one time, which I love that story. Because it's so true. I mean, we had an opportunity with kind of a large conglomerate, and Empower wanted to bid on it, and they custom quoted like almost 150 retirement plans that were part of that opportunity. I mean, it was ridiculous. So, for us, it's been a tremendous opportunity to build scale and change our capacity and revenue model. The other aspect that I think, people should know is, it's really hard, even at our size, to get things done quickly in other platforms. Like record keeping and administration is hard. You're going to have bumps in the road no matter where you're at. Like no record keeper is perfect. The problem is, when I have an issue at Empower or Voya or America, pick a record keeper, we can throw our weight around, but it takes forever to get anything done. I mean, Mark and Dave, you guys alone have been tremendous resources, but as is everybody else over at Alerus, like our experience of just getting things done has been great. I mean, we had a high profile client. We needed a plan document done over a weekend in 2 days, and like you guys did it because it was important to us, right? So I just, we don't want to put you on it again like for all of them that way, but I just think advisors should know this isn't like, hey, we wanted to put together a PEP and did an RFP and picked a record keeper. This is really a true joint venture partnership to make sure that it's well supported and successful, which I think is just very different.
I appreciate those comments, and I think the biggest thing you said is scale, and we get some scale from this as well. Workplace Retirement Solutions makes our job easy because stuff comes in good order. It's a short onboarding document, but it comes in good order all the time. So it's great. Appreciate your comments. Bradley, even though RMS is not a quote unquote MassMutual product, right? Because we are an independent provider, they have been able to use their scale and kind of distribution power to negotiate a pretty competitive fee structure, one that I'm quite certain will not be duplicated by Alerus anywhere else. They did a pretty good job in negotiating. If you take a look at RMS, how is it helping you to provide value to clients at the same time, maybe protecting those clients from other advisors coming out and getting put on as AOR or broker of record, that type of stuff? Are you seeing anything that's helping you retain clients from that standpoint?
Definitely. Yeah. And I've said this to the other advisors who do retirement plans, and I've said it to the advisors in our organization, but when they rolled this out with Steve and Andrew and the people that had kind of come together and built this thing, rolled it out, I sat there at that conference and said, oh my gosh, I brought this to my prior mediocre broker dealer in 2022 and said, we should be doing something like this. We should have a solution that is proprietary for our advisors. It doesn't have to be branded MassMutual, but it should be something that we have the ability to take to market to compete against the Ameritases or Ascensuses or the other broad market available PEP solutions that were kind of beginning to proliferate in the marketplace. I'm sitting in this conference and they're talking about it. And one of the things that was stated that I really love, one is our 338 is Melissa's 338. And when I looked at the funds that were in the 338, I'm like, dude, this is a lineup I'd make. This is exactly a lineup that I would build. And I don't have to sit in committee meetings and have the academic discussions and all that kind of stuff. So for advisors at MassMutual who don't have the tools, they don't have RPAG, they don't have the ability to actually build a lineup, there is a lineup that has already been built that other people built that is almost exactly like one that I would build using the same exact software, and they're maintaining all that stuff. So that's awesome. But what they said in the meeting that really got me was, this is a MassMutual specific solution set. So again, there are those other PEPs out there, and you know what? They're available to everybody. When I go try to take over a co-pilot, a census plan, I can broker a record, or like Merrill has these proprietary things. Sometimes I got to break it to take it. I got to strip it and rip it and make it our own. Same thing happens here. This is our product. If somebody else wants to come in and broker a record it, they might be able to gain access to information, but they're not going to get compensation and they're not going to get the same pricing. So we've got this cool proprietary thing that is a competitive advantage in the marketplace. And I do, when I'm bringing PEPs to my clients, I'll benchmark them and bring them spreadsheets of other alternatives, and invariably it'll go to Alerus as the solution because their pricing is comparable or better. And I know for a fact that we've got this closed relationship with this provider versus all those others where they've got all these other producers. So that's one thing that I was like, this is awesome, because now we have the ability to be protected against BOR. That's great. But then the other thing, which is huge, is if you do a 5,500 search on a 401k plan, like I've got a $25 or $30 million retirement plan client, and people are out there, and man, they are just ecstatic to try to solicit my client. And on the 5,500, it's got or on the search thing, it's got the email for the CFO, and it's got the signer's information and all this garbage. Once they go into a PEP or a MEP, it disappears. You can't find them anymore. And so your clients go off the grid for people to be able to, they may not, how the heck can this company not have a 401k plan? They do, but you can't find them in the 5,500 search stuff. That's like one of the best protections. I mean, I think that's one of the coolest things about PEPs is that all of a sudden our clients become unavailable for information and future solicitation from other advisors. So I think those are the two big things. Like the Judy Diamond searches, they just don't exist anymore.
Yeah.
Very cool.
Good stuff. If I could, I would love to steal that phrase from you, though. Strip it and rip it. I'm going to have to find some places to use that moving forward.
Okay.
Hey,
Hey guys, we have a
Go
question in the chat here. Barry has asked for the panelists, do you have a rule of thumb in determining your dollar amount fee and your basis point fee reduction or not? If so, what do you do?
Anyone want to jump in? I mean, I have a feeling we're gonna get 3 different answers from 3 different people. To me, it's really done on a case-by-case basis based on the size and the type of organization. You know, if I have a 5-person plan that the 2 owners, you know, are not going to participate and they have 5 low, you know, compensated employees that they want to have this in place for, and I know that the plan's going to flow $40,000 and there's going to be no roll-in opportunities and the plan's going to be a startup, I'm going to charge more. You know, I'm probably going to charge anywhere from 3,000 to 5,000 on a flat fee, plus, you know, the pre-structured scale starting at 27 basis points that scales down, and, you know, keep it there. You know, if I know that there's going to be a lot of flow, or if there's going to be some like rollovers from an old 401k, you know, I'm doing a small ear, nose, and throat doctor, and he has about $1.4 million of previous plan assets from his previous employer. We're going to set it up, and I know that there's going to be immediately, you know, capitalization into the plan. Then I'm going to keep my, you know, flat charge substantially lower because we'll make up for it on the basis points. But I think you have to look at the average, you know, the annual flow, what the assets will be, and figure out what that will look like from a basis point standpoint. And then that's how I do the back math to say, what's the total compensation that I need to make to be profitable and pay for my staff on this? And so that is going to differ for everyone. I would imagine that, you know, Steve on the call, they probably have a lot more overhead because they have a much larger team. And so they might not want a plan that's less than 5,000 or 10,000 of, you know, annual, you know, revenue. And so they might do something differently, but I'll let them speak for themselves. But to me, it's a mathematical calculation that's really done on a case by case basis, because it's going to be very different if it's a 25-person law firm startup versus if it's a 10-person, you know, construction company with, you know, lower level wages.
And just to chime in, I mean, one thing that everyone should know is that, you know, we gave a default sort of comp structure because we know there's a lot of advisors in the Melissa system that, you know, might not know how to set their fees and things like that, and that's okay. And so we wanted to give something simple to the country to at least just work around, right? But it is customizable. If you want to earn $5,000 on a plan, you can, right? And there are cases where we charge $5,000 as a base fee. But we are really looking at every case individually by, you know, size, time commitment, also where the case came from. If I get a referral from a payroll person and it's a small case that, you know, ordinarily I would want to charge more on because it's not, you know, super attractive or profitable, you know, I might not charge more on it because what I don't want to have happen is I don't want that small client to go, hey, this is too expensive, go back to the drawing board, and then that payroll person bring them somewhere else. So we are paying a little attention to where the referrals come from, you know, as well. We take the approach with the sort of scaling model that we have, and this is why I think RMS is just so great for, you know, your practices, right? Is because for us, like, we want to own our marketplace. It's kind of like when you open up a franchise, right? If you want to open up a franchise, you want to own the same location in the neighboring town and the neighboring town on the other side of you, because you want to own your marketplace, right? And wherever people are going to drive within a certain mile radius, you want them to come to one of your locations and you bring all that money back to the house. So that's the approach we've been taking. Like, let's vacuum up every plan we can, find a way to make sure it scales and we're profitable. And there are cases, by the way, that we lose money on, because of maybe we're doing someone a favor because of where it came from or what have you, or we look at the lifetime value of the client to say, hey, you know what? And record keepers do this too, by the way. Hey, you know what? We might not be profitable on this client for 3 years by the time we finally do a buy sell or some other business with them. But that's okay, because if we own our marketplace, like, all the revenue comes to the house. So that's the approach we take with it. I mean, I would tell you that there are instances where we're defaulting to $1,000 and 27 basis points. We've started testing, like, making our base fee, $2,500 as well, and then showing them what it looks like on a monthly basis, which optically is more attractive. And then remind them that you can pay it however you want. It can be pro rata to the balances, if that makes sense. So I think that's how you show it and how you speak to it, I think is important to keep in mind.
And the one additional caveat that I'll put out there is, if it is a startup plan, you need to know the tax credits, because if the credits are use it or lose it, you don't get money if it's not spent. If you can make a higher fee and it costs the client nothing, do it, right? I mean, if they're already going to fully utilize all of their tax credits and your fee is going to be out of their pocket, then maybe you don't. But if I can go to them and say, you're literally not going to spend any money for the first 3 years, and I can get paid an extra $1,500, the clients don't care, because at the end of the day is they see that they're not making payments net of tax credits, and their CPA or accountant will confirm that for them. So you just need to also be mindful of, where's the plan coming from? Do they get tax credits? Who's the referral source? I mean, there's a lot of things, but same deal, case by case basis.
And I just threw my cell number in the chat. So if anybody wants to have a deeper conversation, I'm happy to share ideas or go deeper with the time we have now to keep moving.
I hope people are taking some notes, because there's some nuggets here. I mean, there's some really good thought leadership here on how to do stuff. Max, I've kind of been watching what you're doing from afar. I know we've got to connect a couple times at our PEG conference and such, but if you take a look at the PEP industry, there's been a lot of PEPs that have been set up and designed that give away flexibility, in an effort to gain efficiencies and scale, that type of stuff. I would think of one provider that's got a green line. RMS has some flexibility built into it. I would be interested in you maybe sharing how you've used that flexibility in plan design to do more sophisticated planning from some of your employers.
Yeah, I mean, there's no shortage of flexibility in the design. You can change every aspect that you want, not only from a plan design perspective, but even from an invoicing perspective, right? What do you want paid for by the employer versus the participants? I mean, you can do some of that at other PEPs, but again, at the end of the day, is how we charge. You can't control at other PEPs. I can't take a flat fee and a basis point at any other PEP besides RMS EasyPlan. That's just not available. So that's one of the biggest things for us, there. But the fact that you can also grow and leverage the same third-party administration for things like cash balances. One of my partners is big into exit, succession, and continuity planning. And so we work with a lot of businesses that are preparing to sell in the next, 7, 5, 3 years. And so when we're looking at, what do you think the business is, so they have a partnership that, they figure out the business value, right? But then our team, my partner Kirby, really runs the financial planning division. So we need to figure out how much money do they need from the sale of the company, because you could sell the business for $6 million, but if you're going to still run out of money before you're done, and you're going to have to go back to work, it's not okay, right? So how do we figure out how much money they need from a financial planning perspective? Joe does all the exit, continuity, succession planning. And then how do we leverage and utilize the qualified plan for some sophisticated tax qualified planning to remove a lot of business outside? And so, we looked at a company, $45 million revenue pet manufacturer, and they had a simple IRA. And so we went in there, we took a look. He wants to transfer the business to his daughter. And so, we have the wife, now working for the business. They're maximizing their full contributions. They're doing a profit share to both of them. We've structured a cash balance. He and his wife are by far the oldest. We're able to skew a bunch of money, and we're moving, close to $500,000 a year out of the business And right now, they're paying 42% taxes between state and fed, but out of the business, avoiding all the taxes now. We're over the next 3 to 4 years, we're going to move, close to $2 million out, plus hopefully some growth. And then when he transfers the business, there's less of a need from an income perspective for a sale or from an installment sale perspective. And then once the business is transferred, he's a pretty simple guy. So their tax rate's going to drop from, 40% taxes closer to 20% taxes, right? So he'll be able to draw that out over an extended duration at a much lower tax rate. And if there's any, additional Roth planning and so forth, we can give it that 20 lower. So we've used it as an overall planning vehicle that is all coordinated with business planning, exit continuity, succession planning, overall personal financial planning, long-term retirement cash flow planning. But the qualified plan, if it's not getting evaluated as part of your overall strategy with a business owner, you're missing the boat.
Right on. Yeah, good stuff. Hey, we took a poll. Did we ever do the results on the poll? Kind of got sucked into questions, and it's been a pretty good conversation so far.
It looked like the bulk of the people were kind of 0 to 5, 5 to 10, and then there was a couple that were managing more plans. But the bulk of the folks that answered and responded, I recall being on kind of the newer market space of managing a handful.
Exactly correct, Max. There was one, I think there was 2 or 3 professionals out there who had 20 plus, and the bulk were in the less than 10 plans. So a lot of folks learning the business or dabbling.
Yeah, and I'll even touch on that. I mean, at the end of the day is, we talk about 401ks is managing assets is FINRA and SEC. Managing 401ks is regulated by DOL and ERISA. And they're very different regulatory bodies. They're very different regulations. There's a lot that goes in to managing 401ks. And so dabbling in the 401k market is very, very, very difficult because you have to understand all the compliance. And if you don't have the systems and the teams and processes in place to make sure that you're doing everything as a planned fiduciary, and if you're doing a standalone plan with ADP, Paychex, Empower, Voya, John Hancock, Fidelity, who cares, is you are the co-fiduciary of that plan and you bear liability that if they are sued, you are sued. Versus in this case with the 316 is all of that stuff is really bundled up, and really the liability boils down to submitting payments on time to the plan and having accurate census data submitted to Access Retirement. And so you alleviate a lot of the liability from yourself, and it allows you to dabble in plans without carrying all of that liability on your back. So to me, RMS EasyPlan, if you're a dabbler, don't ever do anything else. If you're actually full-fledged in the marketplace, there will be certain scenarios where other plan providers from a cost perspective or a need perspective will make sense. But if you're dabbling and you're one of those people that are 0 to 10 and you don't ever plan to build a full business like, some of the folks here on this call, this is a wonderful, wonderful, wonderful way for you to do that without all the liability and all the headache and expense. And I mean, screwing up a relationship with a client, because you screw up the 401k, the client's probably going to leave you entirely. They're not going to just move the 401k and keep you as a personal advisor. So you need to be mindful of the overall relationship, and this really helps you with that.
Let me just chime in real quick. Steve kind of touched on this a couple seconds ago, but Max, to what you just said, if you are going to grow a practice, having different lineups in every retirement plan becomes onerous. I have 100 plans with 100 different lineups. It would be awesome to have 100 plans with one lineup that I don't have to screw with. So if you are going to build it and you're going to get to 10 or 15 or 20 plans, this is also a great way to do that, because you, again, even if you don't have a 66, you can get paid a fee within the MassMutual system. You can layer compensation into the assets of the retirement plan. You don't have to screw around with the fund lineup, and you can focus on the stuff that we should be doing best, which is the planning, the buy sells, the interaction, all that kind of stuff. And you're offloading it. I always feel like people feel like they take the easier option as like, I'm taking the stupid road or whatever. You're not. You're actually taking the more efficient, better road, because then you can focus on the other things and be more profitable.
Yeah, really good points.
So we've got another question in the chat here.
Yeah, David.
Sorry,
yeah,
Steve.
I'll let you read it.
Go ahead.
Answer.
Yeah, it says, what has been the biggest objection to overcome in attempting to sell RMS to existing plans?
Yeah, no. So there's probably a couple things there. I mean, one I would say I would say that, we still run into clients or prospective clients that, think they're Warren Buffett and they want to be more involved with the line, right? And you're always going to run into the CFO that's more of the do-it-yourselfer and, and wants to be more involved. And that's okay. Like, that particular client might not be right for any PEP, not RMS, like any PEP, any 338 program for that matter. I would argue that's less than 0.5% of clients. I've never actually won a case on lineup. I don't think it certainly plays a role, but it's not usually what they care most about. But occasionally you're going to run into I want more investment flexibility because we want to be involved in picking funds. Occasionally, particularly in the Northeast, we run into brand things around, every CFO in the Northeast used to work at Fidelity. I want Fidelity. I want to be at Fidelity, and that's where I want to be. Cool. Like, we can run your plan at Fidelity, and that's okay. I'm not going to lose a deal over it. And we've had some cases that have gone to Fidelity and now they want to PEP, right? So, being able to offer sort of one bundled 316 full fiduciary outsourcing program, for the most part, causes people to be like, wait, what's the catch? Why wouldn't I do this? And then I would say maybe lastly is they maybe just have a misconception about PEPs in general. There's like 300 PEPs across the country now. They're not all created the same. Most of them have massive conflicts of interest that are created by providers that serve providers and have rigid requirements. So I would say, for clients that have at least been exposed to PEPs, or maybe you're in a competitive situation against another, it's making sure that they understand what a PEP really is and the legacy of where it came from, the traditional MEP space, and why ours is structured differently.
Good answer. I can't believe we're almost out of time here. I got a bunch of really good questions left, and I think I only got time for one more. So I'm going to choose wisely. When the government came up with PEPs with the Secure 2.0, they're really trying to solve the problem for the small plan, right? But one of the things that we're seeing is a lot of larger plans adopting PEPs, right? And maybe it's the most effective thing for larger plans. Steve, I know with like SFP, we've seen you guys bring a number of larger plans, 500-600 employees, tens of millions of dollars in there. What are you seeing that those larger employees are looking for when they look in the direction of RMS or any PEP for that matter?
Yeah, I would say, down market clients, just give me something hands-off, turnkey to plug into. Like, I want to spend the least amount of time on my retirement plan as possible. As we move up market, middle market, large market, the conversation shifts a lot. These are people that have HR teams in place or outsourced HR, finance departments, things like that. And then you end up with employees of a company taking on liability for a place they don't own. When I'm talking to an HR person that signs the 5500 as the name plan administrator for a place that he or she does not own, telling them that we can eliminate that is usually very attractive, not just to that person, but to the organization that didn't even realize they were necessarily putting them in that position, right? And they don't want the exposure. So, being able to talk about the liability shift that occurs up market, they care. You're going to pull attorneys into that conversation, believe me. And if you ever want the greatest attorney on the planet to be a part of that conversation, Heath Miller from Access Retirement will bang out more complicated stuff walking around his pool with his earbuds in than anybody else ever will. So we have a tremendous resource in Access Retirement who's involved here as well. We have an example where we had a plan going to RMS that was looking at Lockton's PEP, and we were within $10,000 of cost. I mean, and we were cheaper, by the way, by $10,000. And at the end of the day, they were like, well, and this was a plan out in Seattle. At the end of the day, we're like, well, Lockton's got, an office here and, that kind of thing. But what resonated with them the most was liability. And I asked them to pull out the service agreements that Lockton put in front of them, which ultimately indemnified Lockton for everything they do and pointed the liability back to the client. Most PEPs have these conflicts where they have to basically say, you adopting employer, authorize everything we do. Part of the reason why Access Retirement is involved is because of we're the only probably non-conflicted PEP in the country I'm aware of. Access Retirement is that check and balance and shield in the relationship, which means we don't have to, put the liability back on the client. So the liability, certainly eliminating audits and cost and the workload around an audit. I usually ask a client, why would anybody voluntarily go through an audit and report themselves to the Department of Labor every year if they don't have to? That seems crazy to me, and that line usually lands, but I would say be prepared to have some liability conversations at market. That's what matters to them a lot.
I think those are great points. So we've kind of come to the end of our time here. Dave is going to wrap us up a little bit, but before he does, I want to thank all of the panelists for joining us today. This was a good discussion. I hope we can continue it, maybe at Napa that's coming up here in the spring. Great discussion. Thank you all for your participation. Thanks, David Carrillo, and the Workplace Retirement Solution Group as well. And with that, let me kick it over to Dave Rogers.
And before Dave finishes up, I would just say I saw one last question. Steve Brunson asked, who's the best resource to become more familiar with the terminology and regulations of these plans? There are wholesalers that cover the entire country for Alerus. Talk to them, they can help you. Also, the MassMutual Retirement Workplace Solutions you have a dedicated partner within the Workplace Retirement Solutions at MassMutual. So you can also speak to them. They're incredibly knowledgeable. So, reach out to MassMutual's Workplace Retirement. They can also direct you to who your person is at Mass. They can also direct you to your wholesaler at Alerus. So great resources. Obviously, Steve Jonian put his phone number in the chat as well. If you have more specific questions, I'm sure he can help you. But I will now kick it back to David. Sorry for interjecting.
Thanks, Max.
Final plug. Workplace Retirement and MassMutual, they're doing like an advisor pathways program that would be great for people to be a part of, specifically around this. So shoot me a note. I'm happy to get you plugged in there.
So just to put a bow on this, thank you everybody for taking your time and sharing it with us today. I hope it was beneficial. I've been taking notes along the way of all the nuggets that have been thrown out here, and try to boil it down to a couple of them that I'd like you guys to walk away from this meeting with. And number one is that there's a community in place to help you be successful in selling RMS EasyPlan. It starts with Workplace Retirement Solutions at MassMutual, but right on top of that, you've got the wholesale team at Alerus that is here to help you succeed. Steve has offered to help out as well. Michael Halloran is also an outstanding resource. There's a lot of resources here to help you be successful. Second thing, there's simplicity in this, from paperworking a client to how the plan actually operates. The complexity of retirement plans is taken off of the plan sponsor and really off of the advisor in a lot of ways, and it's put on the shoulder of us, the operators of the PEP itself. So don't be discouraged by the complexity of retirement plans. This opens up the plan market to the folks who are not specialists. But with that being said, specialists are using this as a tool. They're gaining scale with it and building their businesses with it as well. It's good for small plans and large plans. And with that, I'd like to ask you all, as you're going away from this, take a look in your books, find a couple of business owners you've got a relationship with, give the wholesalers a call, give the Workplace Retirement Solutions folks a call. Let us help build a case to help you win some clients and make this a profitable time for you. With that, thank you all very much for spending your time with us this morning. Look forward to catching up with you all soon.
Thank you all.
Thanks, everyone.
Happy Thanksgiving.